Welcome to an introduction to economics. This short podcast is the last in the series about firms and is brought to you by Park Bench Tutors and narrated by David Hopcroft. For more information about Park Bench Tutors, please visit parkbenchtutors.com. In our last podcast, we looked at monopolies. In this podcast, we shall consider an oligopoly. How do they differ? With a monopoly, we are talking only of one firm, but with an oligopoly, we are considering a small number of firms that have come to dominate a market. A firm may manufacture only a few products or a large number of brands, but can still be a part of an oligopoly. An important point to remember is that in an oligopoly, each firm has to consider the actions of other firms, and how any action they might take would affect the market. If a firm raises or lowers prices or alters output, then what will be the response of the other firms? Examples of firms that form an oligopoly include those in the detergent industry, automotive industry, and gasoline retailing industry. Think about how you would class supermarkets and why. The prices that are charged by firms that form an oligopoly tend to be quite stable. Why should this be so? The map here shows a single firm in an oligopoly selling at a price P1 and producing an output Q1. If the firm were to lower the price, then rivals could be expected to do the same. So at any price below OP1, the firm would be facing a relatively inelastic demand curve. If rivals do not lower prices, the demand curve is D2, D2. If rivals follow similar price changes and lower theirs, the demand curve is D1, D1. More simply, if the firm lowers its price, then demand would increase providing rivals do not lower prices. If rivals lower prices as well, the demand falls to D1, D1. The firm believes it is facing what is known as a kink demand curve that follows the line D2A D1. The marginal revenue associated with this is BCDE. Note that it has a discontinuity in the CD portion. Remember that for profit maximization, the marginal cost curve must cut the marginal revenue from below. So the marginal cost curve must be somewhere in the region of discontinuity, or a curve that lies between curves MC1 and MC2. Since this indicates there might be large changes to marginal costs, then there is little incentive to cut prices, or to cut the quantity produced. The theory still does not tell us a great deal about the factors involved for individual firms who are a part of an oligopoly. To determine where the kink really is, we would need to know the profit maximizing price and the profit maximizing output. The firms in an oligopoly tend to follow a pattern of non-price competition, where money is spent on advertising to attract new customers, or packaging is altered, or there is an emphasis on after-sales servicing or some other factor. The advantages to firms in the oligopoly of following this pattern is that it avoids a price war that might lead to losses. You might want to look closely at the advertising of supermarkets with their trolley of goods. Selecting a range of goods to demonstrate that your prices are cheaper than those of a rival appeals to some customers. However, the customer should be choosing which items are in the trolley and over a whole range of goods that might be useful to them. So are these just phony price wars? The best known cartel is that of OPEC, which is a group of countries who effectively can influence the price of crude oil by controlling output. This is an open agreement between the countries, and everybody is aware of what is happening. In individual countries, which include the United Kingdom, the idea of price fixing by a group of firms acting together in collusion is prohibited. Cartels require a central body to set prices and agree policy. It has been argued that this means they are not likely to survive for long because there is an incentive to cheat and to drop prices or to increase output. It should be pointed out that OPEC has lasted for almost 50 years. but that this may be a special case since it does concern only a single resource. By acting as a cartel, the price is set at PM and the agreed output is QM. Setting the price at PM exceeds the marginal cost, where the price would be PC. Would a cartel member benefit by producing more at the lower price PC? Well, if all members did this, then profits would fall, so there is no real incentive to do this. A position of interest is when one firm comes to dominate a market, but there are still a number of smaller firms that continue to produce good X. In this situation, the dominant firm will set the price, and this has to be followed by the smaller firms. The smaller firms are called price takers. The market demand is given by the line DD, and the curve SS represents the sum of all the marginal cost curves of the smaller firms. The dominant firm subtracts the demand curves of the smaller firms to end with a demand curve which is the excess demand. To maximize profits, the dominant firm needs to set a price where the marginal cost curve cuts the marginal revenue curve, so it produces a quantity Q1. The smaller firms produce a quantity Q2. The sum of Q1 and Q2 equals Q star, which is the total market demand at price OP1. This is not efficient, since marginal costs for the dominant firm are less than those for the smaller firms, so if the dominant firm produced all of good X, this would be more efficient. You might want to think about why a dominant firm might not be willing to do this. Whilst the model we have considered is that of profit maximization, this is not the only model. There are models based on other assumptions. The interests of stockholders or shareholders and managers may differ. Stockholders or shareholders want dividends. Managers may be more interested in growth or expansion of the firm. There is a minimum level of profit needed to keep the firm in the market and to satisfy stockholders or shareholders. Only after that can managers focus on other objectives. A second model suggests that managers will tend to focus maximum revenue for sales, with or without a profit constraint. With this model, sales maximization, the output for maximum profit, is Q1, but this is not the point for maximum revenue. If the firm attempts to maximize revenue from sales, which is an output of Q3, it may even be producing a profit below the minimum required for stockholders, or to produce growth in the company. It should be noted that often the peak for maximum revenue and the peak for maximum profit do not coincide. At an output of Q2, the firm may be close to maximum sales revenue and can still produce the minimum profit. However, using this model, if fixed costs increase, then profits fall and the point Q2 would shift left, meaning a lower output. The model does not really explain how a minimum profit level is determined. Behavioral models probably offer a good account of factors that are taken into consideration, but are difficult to model. They suggest that pricing and output are subject to a number of interested parties, whose objectives may differ, coming to some type of compromise. These interested parties will include stockholders, managers, workers, and trade unions. Target levels will then be agreed, but the model may not be fully efficient and have organizational slack. In some cases, payments may be made to ensure the target is adhered to, which adds to inefficiency. There is evidence that many businesses do not really adhere to any of these models consciously. Often accountants are employed to do full cost pricing for production, or cost plus pricing. Full cost pricing takes account of fixed and variable costs. The selling price is then determined by adding a markup. This does not explain how the markup is determined. Around the 1970s, a prominent US economist suggested that large companies had grown to the extent they were outside the usual factors that determine price and output, and that they were able to create their own markets through advertising and other means. These ideas, put forward originally by Kenneth Galbraith, suggested the company was controlled by technostructure, which simply means that the managers, accountants, technologists and computer experts and so on determine what happens. The subsequent crash of many large countries including Chrysler, Burma Oil and British Leyland in the United Kingdom, suggest that no firm is able to operate outside the usual market pressures. This ends the last in our series of podcasts about firms, brought to you by Park Bench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Park Bench Tutors, please visit parkbenchtutors.com.